Right, hello everyone. I hope you can hear me. My name's Richard Bray and I'd like to welcome you to our presentation on economic substance. With me on the panel today is Stephen Cuddihee, a business development consultant and non-executive director, whose bio is here and we'll circulate these afterwards. Gavin Farrell, advocate for Fair Russian Farrell, and Mark Colver, Tax Director of Thornton. So welcome everyone. But the first point, just before I hand you over to Steve Cuddihee, is to say that if you have questions for us during this presentation, you'll see there's a point on the left-hand side of your screen that you can type in those questions, and we shall come to those after the presentation. We're also going to save you the embarrassment of seeing us speaking, and we'll just do this on the mic. So with no further ado, I shall hand you over to Steve Cuddihee, who will go through an intro and the general topics to be discussed.
Thank you, Richard. Okay, I'll run through this briefly. I'm just going to give an overview of how the economic substance regulations came into force, and then I'll pass it on to the panel to begin the discussion. So in 2016, the EU Council committed to coordinate policy efforts in the fight against tax fraud, evasion and avoidance, which led to the establishment by the EU of a list of non-cooperative jurisdictions for tax purposes. They formed a code of conduct group which had been established in 1998 to assess tax measures and regimes that might fall within the code of conduct, and was instructed by the EU Council to undertake a screening process whereby jurisdictions, including Guernsey, were assessed against three standards in respect of tax transparency, fair taxation, and compliance with anti-base erosion and profit sharing BEPS measures. Although the conduct group raised no issues in respect to the Guernsey standards in regard to tax transparency and anti-BEPS compliance, during the screening process, they did express some concern that Guernsey did not have a legal substance requirement for entities doing business in or through the jurisdiction. And they were concerned that this could increase the risk by which that profits registered in the jurisdiction and are not composite with the economic activities and substantial economic presence in Guernsey. These concerns were articulated in a letter to Guernsey in November 2017, and in response, Guernsey made a commitment to address these concerns by the end of December 2018. As identical concerns were raised in Jersey and the Isle of Man, the Crown's dependencies worked closely together to develop legislation to address the conduct group's concerns. The states of Guernsey therefore then decided to comply with the new criteria, the main driver for that being that they were concerned that being included on a non-cooperative EU list could result in sanctions being imposed by EU member states, which could damage Guernsey's reputation and economy and undermine its status as a well-regulated, transparent and cooperative jurisdiction. Therefore, Guernsey agreed to implement new tax legislation to meet economic requirements under the new regulations, which was formulated in the Income Tax Substance Requirements Implementation Regulations on 2018, which came into force on the 1st of January 2019. The legislation has been designed to address concerns that companies could be used to artificially attract profits that are not composite with economic activities and substantial economic presence in Guernsey. With this in mind, the legislation requires certain companies to demonstrate that they have substance in the island by being directed and managed, conducting core income generating activities, and there being adequate people, premises and expenditure. And I'll ask both Mark and Gavin to discuss these points further in more detail. The substance requirements apply to following categories of geographically mobile financial and other service activities. The relevant activities identified by the OECD Forum on Harmful Tax Practices. And these include banking, shipping, insurance, fund management, finance and leasing, headquarters, distribution and service centres, and holding companies, pure equity holding companies, and intellectual property, for which there are specific requirements in high risk scenarios. All tax resident companies will be required to provide more information in their tax returns to ensure the above activities can be identified. There are exemptions to the new substance regulations. Collective investment schemes are not covered by the new regulations. Therefore, the purpose of this webinar is to consider the impact of the new substance regulations on Guernsey investment managers. And with this in mind, I'd like to now pass over to the panel. And in particular, I'd like Gavin to start and just ask him, in reality to management and control in Guernsey, what that actually means in perspective for Guernsey fund managers.
Well, I think we've got to go back to the very basis of the of why this legislation was put in place. And as you said, the origins of the substance legislation was very much dictated by BEPS, which we had to adopt, and Guernsey was one of the early adopters, and also by the BEPS, especially Action Point 5, which is the economic substance requirements, which was then adopted by the Code of Conduct, which was set up by the European Council of Ministers when assessing Guernsey for the purposes of its famous white or black list. So the whole purpose or the genesis behind the substance requirements is a bit of a fallacy for us when we look at it at the Guernsey level, because it is very much there, and as the name says, under BEPS, for the to avoid the erosion of profits. And the erosion of profits is when an entity accumulates profits in a low tax jurisdiction in order to bypass, I wouldn't say avoid, but in order to bypass the generation of profits in another jurisdiction, normally onshore, will be taxed to a greater extent. At the very practical level, most of the fund management businesses that we do as we're looking at fund managers, the fees that are generated via the Guernsey management companies tend to then be paid by the other service providers, and in this case, primarily the investment advisor or the sub-manager, who are obviously based in onshore jurisdictions for most of the times, and therefore the profits are therefore taxed there. So unfortunately for us, the main driving purpose, which is to avoid the centralization of the profit in low tax jurisdiction, in practice doesn't really apply to us. And unfortunately, we therefore have to comply with the substance requirements, failing which it will be a technical breach as opposed to a breach of the principle or the ethos behind it. So that's quite a long introduction as to the way I've always viewed the substance requirements. It's a necessity, obviously, for us at the political level in order to ensure that we're not viewed as not being transparent vis-a-vis our international obligations. But the main purpose doesn't really apply in most of the cases by virtue of the payment of the fees off island. However, if we look at the substance requirements under the Guernsey regulations, and again, as led by BEPS and the European Code of Conduct, we can see that it is in effect a codification of the best practice that has been applied or ought to have been applied, especially over the last 20 odd years. If we look at the management and control, and I'll let Mark talk about obviously the requirements under the tax legislation, it means that the entity has to be properly managed by the board. And that's always been the case either in law, in statute, if we look at the various Companies Act, or with the explanation provided by case law. With the development of corporate governance, that's always led the Guernsey entities to strengthen the process and procedure where the decisions are taken, considered and implemented at the Guernsey level in order to comply with the corporate governance requirements that are just set by the general law, or also within a regulated area by our regulator, the GFSE. There's obviously also been all the pitfalls that relate to the duties of directors, when we know all the directors who've been sued for their breach of fiduciary duties, very often because they have not complied with them in a true sense of managing or overseeing the activities of the companies. And that has always obviously strengthened the view or crystallized the mind of a traditional non-executive director or executive director in Guernsey in order to ensure that it complies with its legal obligations. We also have the various codes of corporate governance. I mean, within our industry, we obviously have the general code issued by the Guernsey regulator, but we also have the combined code or the AIC code, when we have entities that are listed on a premium segment or otherwise, which also require, obviously, the directors to actively manage and control the affairs of the company. And finally, we also have the code of conduct, code of business rules that are issued by the Guernsey regulator, which again require the effective management. So all that to lead to my conclusion that the economic substance requirements, which were implemented by legislation in Guernsey, were very much a statutory requirement that was implementing in effect what we had been doing very much so for the last 20 years. So it's nothing new in Guernsey. It's something that we have been doing, or we certainly ought to have been doing. It's been an increased obligation imposed on entities based in Guernsey. It's been an increased requirement imposed on the directors, either self-imposed or imposed otherwise. So for me, the difficulty was not just doing it, but being able to tick the various boxes that we have as part of the guidance notes issued by our revenue service, but also to be able to codify everything that had been done as a matter of best practice into one single form that we now have to file with the revenue service. And the final point that I would say in terms of the best practice is we mustn't forget, of course, even though it's been, I would say, forgotten, but put on the wayside a little bit, the AIFMD requirements, which we had to strictly adhere to, especially when we had to ensure that the portfolio management and the risk management, either of those were undertaken in Guernsey, which tended to be the general risk management and therefore the oversight in itself. So the economic substance, again, is just putting everything that we have done at various different levels into one bag and one main requirement for reporting purposes.
Could I just ask a question before we go to Mark? Given that normally there also has been on Guernsey management companies at least one Guernsey director, can you see a development or continuing event where there may be, I mean, best practice may include one or at least or two, but can you see a development where it will become a requirement to have two Guernsey-based directors on a management board?
Well, the requirement is for the majority of the directors, to be based or certainly just take part from Guernsey.
But Guernsey resident, having Guernsey resident directors, two Guernsey resident directors.
Well, I think it really helps because if you have to have an effective management, even though if the boards are appointed in a non-executive capacity, you still have matters to be dealt with between each quarterly board meeting. And that's why, and again, it's not obviously a self-serving argument to generate sufficient, business for the local professional executive community, non-executive community, but it's very much a requirement, I would have thought, A, to comply with the, the directed and managed from Guernsey requirements with the majority, and B, for the effective and decisions to be made in practice to run the affairs of a company in between each quarterly board meeting. So yes, I mean, again, we always have to go back to the principles of corporate governance, especially under the code, that you have to have a good mixture of the different levels of expertise. So it's a combination of all the different levels of expertise. And I think that to have the professional directors based in Guernsey who have the overall knowledge of the company and of the running of the affairs, for them to take the decisions in between meetings is a good thing. Yeah.
I would actually just add that from a perspective of a fund administrator, having two local directors that you can contact is just fantastic. It makes life easier from an operational perspective as well.
Yeah.
And I think there's, potentially with the COVID-19, people being unable to travel, that's been a benefit.
Yeah, there's been a relaxation of that, of course, in terms of the economic substance. But it's not just what we have to do in Guernsey, it's the adverse implications on shore. And it's going straight back to the management and control issues that, Mark, obviously from his tax or fiscal perspective, can discuss. But what we're trying to do is to show that there's sufficient management and control in Guernsey so that the affairs of the entity are not deemed to be seen to be undertaken or controlled off Guernsey.
Which I think brings us nicely to Mark. We must be directed and managing, but what we be directing and managing?
Yeah, thanks, Richard. And hello, everyone. Yes, just going through the key criteria which Steve earlier outlined and dealing with directed and managed first. And really, to pick up the theme that Gavin's made, Guernsey was doing the various criteria anyway. In reality, what we're now seeing is that we have to help evidence and document, and then that will result in a tax return at the end of the year being ticked with various boxes, which will effectively just become an administrative exercise. But we were still doing these. So directed and managed is technically different to the concept of management and control, which I think most people would recognise and are very familiar with and has been around for years. And it's always been important that fund managers, these Guernsey companies, have been able to demonstrate that they were managed and controlled here in Guernsey, specifically, of course, to help ensure that they're not perhaps seen as dangerously managed and controlled somewhere else. So a simple practical point would be fund managers would not have held meetings of the board in the UK, and that simply will need to continue. There are 5 criteria that are set out in the guidance, which include that the board of directors should meet in the island at an adequate frequency. During the meeting, there should be a quorum. Strategic decisions should be taken by the company as set at the board meetings. As Gavin's mentioned, the board of directors as a whole must have the necessary knowledge and expertise to discharge their duties. And finally, all minutes and company records should be kept on the island. Now, as I said, I would foresee that fund managers were actually complying with those things anyway. Happy to take questions on any of this detail as we go. The third area of requirement to comply with the substance laws is what we've called SEGA. It's the key income generating activities, which everyone now uses the SEGA acronym for, which I'll continue to do. And there are different SEGAs for each of the 9 different types of activities to which this whole substance rules relate to, as Steve mentioned, the shipping, the banking, the other areas. They each have their own set of SEGA. So again, just to briefly highlight what these are for fund management, they are 4, get that right, 4. They are the taking of decisions on the holding and selling of investments. Secondly, the calculating of risks and reserves. Thirdly, the taking of decisions on currency or interest fluctuations and hedging positions. And fourthly, the preparing of relevant regulatory or other reports for governmental or regulatory authorities and investors. Now, it's worth pointing out that a company does not need to be doing all of the SEGA. So, for instance, a fund here based in sterling may not need to take currency decisions, and that's recognised. These are seen as the key activities that a general fund manager may include, and it's going back to the need to be showing that one is doing those at board minutes, which takes us back to the directed and managed, that board meetings are being held here, and now even more key, that the minutes are helping to record the decisions that have been taken by the board that would cover that SEGA, and that's happening here in Guernsey. It's worth pointing out it is possible to delegate some of this SEGA, to outsource it to other people, other service providers, investment managers. The key is that the SEGA has to be done on island, and that can still, in our view, happen. The fund manager here in Guernsey can delegate, as it's done for many years, to, say, typically a UK investment advisor. It will set that out in an agreement. It will set parameters and obligations, and reports, etc. will come back. The board will always be responsible for taking the primary decisions and having set primary objectives. And that now can just be evidenced a little bit more to help with this in board meetings. The third area, just to cover off some of the detail, is the need to have adequate people, premises and expenditure. Now, we're happy that there will be adequate people, the board of directors, any of the service providers providing help here in Guernsey. Those people will be counted towards the detail of working out how many people are involved. The premises, again, there will be clearly a registered office here. There will be a Guernsey service provider assisting with that. That will count and qualify for premises. There is no need to suddenly have a set-aside office. And expenditure, again, that will be evident, probably simply from the accounts. The fund manager will be incurring costs as usual, and that will support the detail when it comes to submitting tax returns. So of those three, the directed and managed, the SEGA and the adequate expenditure people and premises, we would see that there is no real change in what's having to occur in Guernsey, as the other panellists have already said. It's more just a question of evidencing things by documenting in things like board minutes, etc. And then I'm afraid a little bit of hassle when it comes to doing the new Guernsey tax return, which has rather more boxes to be ticked and information to be supplied.
I've had to do some of that already, so yes, very much so. Actually, there's something I'd just like to pick up on that one. Actually, is once you've tied in the fact that an entity is properly directed and managed in Guernsey and is doing some of those core income generating activities, you then have the interesting point that non-Guernsey entities that are directed and managed in Guernsey doing those SEGA are also therefore theoretically caught up in these tax substance laws and have a tax domicile. And I know for a fact I'm on the board of an investment management company that's a Cayman entity that does at least two of those SEGA, directing the investments and actually the reports to investors. So in that sort of context, on the board of a Cayman company, what should I be sort of thinking about when it comes to any type of reporting or any other things I should be aware of as a manager or a director of a non-Guernsey entity caught within these substance laws?
I think the basic is this all relates, as Guernsey's introduced, to a Guernsey resident company. Therefore, your Cayman entity, I would strongly expect, is not a Guernsey resident company. It's not, the company is not managed and controlled here. Yes, it may have some activities here, but it's not taxed here. And therefore, effectively, it falls out of the Guernsey substance requirements. It may fall into Cayman requirements because, let's not forget, these laws and rules were brought in by the EU and a whole range of offshore jurisdictions, not just the Crown dependencies.
But since the last year or so, this Cayman entity could become tax resident in Guernsey since the recent changes where we've implemented similar central management and control residency tests, couldn't we? So if it does, because it's for all the Guernsey tax resident entities, so if it is centrally managed and controlled since 18.
Well, that's right,
Guernsey,
and thanks for bringing that out, Gavin, because in amongst the introduction of these laws for Guernsey, Guernsey actually made what some might consider a quite radical change to its corporate tax rules. Guernsey until 2019 did not have the concept of management and control within its definition of what companies were Guernsey tax resident. We had the fact that it was a Guernsey incorporated company or that it was controlled here, which generally meant it was owned here. In conjunction with this substance, we realised that management and control needed to be brought in. So our local tax authority listened to that consultation process, and then the States of Guernsey introduced a change to the tax law, which by itself stands separate to the substance rules, but actually was brought in because of the substance rules. So you're quite right. We now have, since January 19, a management and control test. So if that Cayman company is in fact being operated and managed and controlled here, you're quite right. We could now apply to actually register it as a Guernsey resident company for tax purposes, which would then bring it into substance. It could then qualify for substance because the reality is things are happening here. And it would be agreed that it is not necessarily resident back in, say, Caymans or somewhere else.
Well, that I think
depend on which country.
That has some interesting sort of wider implications, actually, that people might be able to effectively bring the jurisdiction of foreign companies, purposefully into Guernsey.
That's absolutely right. And in the past, the only way of really doing that properly would have been to migrate and re-domicile the company, well, which is, as Gavin will be familiar, quite a legal process. Whereas now we could leave the company as a Cayman incorporated company or UK or whatever, and actually bring its tax position to Guernsey.
And one of the other things which we've spoken about, which I think plays very much to the strength of Guernsey, certainly as geographically European-based offshore centre, is the whole notion of the minutes, because obviously there's a very, very big push on the evidencing of the activities, or the SIGA, or the direction and control being placed in Guernsey. Now, Guernsey obviously has developed, amongst other things, as a back office or corporate secretarial stroke fund administration jurisdiction for the last 30 years. Therefore, there's been a real development as a mainstay and a very large part of the industry in terms of the corporate secretarial services provided to entities. And I think that the substance requirements really, I would say, teases out, but brings out the requirement for better corporate secretarial support, not just in terms of the taking of the minutes, but the high quality taking of the minutes to show the decision process having been made here. And that very much plays to the strength of a jurisdiction like Guernsey, which obviously has a bedrock of that because it's been one of the main parts of the industry. And the final point, if I may, Steve, on this topic is really to look at how it affects, or what sectors it affects in Guernsey. So if we take three of the, not the three main, but three of the main areas that we deal with funds, because again, I presume this is led at the fund industry. The first point is that obviously funds per se are not subject to the substance requirements unless recently they're self-managed. So I think that's a very important part to play. It's only with regards to the fund management unless the funds are self-managed. So if we take, for example, two of the large sectors and the crown jewels that we have within our funds industry, which is the private equity and the listed fund. If we take the private equity, then going back to what Mark was saying, the majority, not exclusively, but the majority do appoint an investment advisor who is based offshore, and investment advisors are specifically excluded from the legislation because they don't take the decision for the entity, they simply advise. So if you have a GP, which itself would be seen as undertaking the SIGA, but based on recommendations coming from an onshore or non-Guernsey investment advisor, then provided again, the actual, it's properly directed and managed, it goes through the SIGA, so the income generated activities are undertaken in Guernsey, and prima facie, by the sheer virtue of being advised as opposed to managed, it would comply with the substance requirements. If we also look at the fund or the listed fund, where you have a fund that appoints a discretionary manager offshore, then that is completely out of scope because the fund themselves are out of scope, and therefore we don't have to question as to whether the outsourcing of the management is indeed or causes an issue for the substance, because the problem doesn't arise by virtue of the collective investment schemes themselves not being caught. And then, of course, there is what we're seeing more and more, which is the self-managed entity. And I think it's important to remind ourselves that even if they are funds, by virtue of being self-managed since the recent changes, Mark, I believe they will now become subject to the substance requirements.
Yes, yeah, that's right, Gavin. Yes, and again, there may be some investment managers activities carried on in Guernsey which actually don't quite fall within the fund management definition for the purposes of substance. Again, they will not have.
Yeah, the big question, because it hasn't covered, say, for example, the managers of segregated accounts, because the guidance concentrates on the fund management industry, which is obviously the largest part. But I would have thought that with the, the activities that constitute SIGA, so the taking of decisions of the holding and selling of investments, and also the preparing of the reports and return. If you had an investment manager that only dealt with segregated accounts, then if the issue arose, then presumably by implication we could apply the relevant parts of SIGA if ever indeed a question arose as to the substance or the economic substance of the manager for the large, private clients on a segregated account basis.
I agree. Yes, and indeed, to a large extent, we're replicating what has gone on for many years, particularly with the UK, in respect to the UK's own designed investment management exemption regime, which has been around for donkey's years, which aims to allow UK-based investment advisors to advise funds without risk of then bringing that fund onshore into the UK and allowing it still to be considered, managed and controlled, etc. here.
Right.
So again, Guernsey is very familiar with those types of arrangements and the agreements, and I would see that if there is a need to prove that SIGA is being taken place by the board here, that would be satisfied. So again, in reality, coming back to the earlier point, in practice, no real change required other than just evidencing matters.
And form filling.
And
Form filling.
at the end.
Can I just touch, if you like, on the fund being exempt, but how about if the fund is holding an SPV that is doing, say, one of the other relevant activities? For example, it might be holding an SP that is a pure equity holding company, or perhaps an IP company, or maybe within their structure they have a holding vehicle which does the financing and leasing between some of the other funds.
Well, Richard, to an extent, the fund would be exempted, but in fact, the SPV is probably not itself included in any of the previous 9 activities anyway. If it's a property holding company, that's not within substance. If it's an investment company holding investments, it's not within substance. Actually, you have to remember to look back to, are you one of the 9 categories? So fund managers are, funds themselves are excluded, and therefore likelihood is any of the entities they own won't actually even be in one of the activities.
But if they do fall, say, the pure equity holding, and again, I agree, it's really linked around security, so not so much property. But I don't think we can use the argument, well, it doesn't fall exactly in that category, therefore we're out of scope. I think we have to be possibly realistic.
Well, yes, but an investment company that's trading is not within the guidance of pure equity holding, because it's doing something. It's carrying on a business, albeit an investment business. So I would say it is not a pure equity holding to fall within substance. And even if it were, then actually the requirements for that particular category are far less onerous, and they don't include SIGA. They don't actually include directed and managed, etc. They are far less requiring compliance, and frankly, I would
the guidance actually says
company to pass.
Yeah, I think that the guidance actually says the expectation is that there will be at least one meeting, but it knows that it's a passive activity, and you would probably have at least one meeting in any event for general corporate governance and legal requirements.
I think it'd be unusual for any company not to at least have one annual meeting.
Yeah.
And the reporting should be fairly straightforward on that sort of one then. To be honest. Okay, and should we look at, of course, the impact of COVID?
Can I just, before we go on to that, I just wanted to come back to you when you were talking about corporate secretarial, etc. I think one of the changes you have seen is from the new substance regulations is that when people are now attending meetings,
yeah,
the most administrators I work with are now keeping registers
yes,
of actually where you're either dialing in, or if you're physically present. If you're not physically present at the meeting, but you're in Guernsey, they're asking where you're located, and they are keeping registers to be able to demonstrate.
But I think, Steve, we used to do that for the onshore central management and control rules, and there was always the issue if you ended up having a majority of people who were not in attendance in Guernsey, be it Guernsey residents or not, then you had to carefully go through the attendees list and to ensure that the majority were based here. I mean, there's a number of practical ways in which to deal with it. And again, it's not just to pay lip service to any tax authority or requirement, but just to also look at it from a governance perspective. And the way we've done it in the past is to institute committees, for example, if we know that we're not going to have a clear majority of directors based here. So you can have a situation where you impose the obligation on the one director who's based in Guernsey to make the decision, and provided it's done I mean, all this is undermined by the fact that it's not paying lip service, and it's not a paper exercise where you just say, yeah, he did this in Guernsey, therefore, or it has to truly be undertaken. That's where, again, the minutes are very, very important.
And the person being delegated has the right to experience.
But that, again, that goes back into the expertise requirement, which is based in all the codes of conduct, the general principles under case law, under statute, under AIFMD, under the COB rules, under the various combined codes. So, yes, I think we're starting from the point of view that the directors who are appointed are not numpties. We're not following the Odeco system. It's not people who are just turning up under the old SAR clerk, as we used to call it pre-99, where you had a farmer and his tractor and 5,000 directorships. So I think this whole discussion is based on the premise that the directors who are appointed know what they're doing and they have the appropriate level of expertise and knowledge, etc.
Fit and proper. I think it's a phrase from me.
Well, we have to. The Schedule 4 is a perfect example, for the requirements of directors of the Guernsey regulated manager.
Which leads into the question around COVID, perhaps, in the sense that I think we'd all recommend now that board minutes document, as you said, as they have been, in terms of who's present, and that the call, if there's telephone attendance, that the call is being instituted from Guernsey, so it's considered a Guernsey meeting, that the chairman is Guernsey present. And the COVID situation, it's a slightly strange one in that Jersey came out and officially gave some relaxation. Guernsey were a little more cautious because they felt they didn't want to publish a relaxation in view of not being able at the time to communicate and agree that with the EU. But there has been a local Guernsey International Business Association release, which has been accepted as can be used for practice, and that recognises the reality that at the moment people can't travel to Guernsey to attend board meetings. And in practice, there will be this relaxation for a period of time, but the key I would recommend is that the minutes document the fact that it's an unusual occurrence for those directors not to attend, and that they would have attended, and that would have been simply evidenced as in the past, and that the minutes just record who's there, why they're there, and why they're not there, which is perhaps a slightly unusual feature to actually document why you're not where you would normally be. And I think that would be something that then, should there be any queries in the future, would help evidence that relaxation can be taken the benefit of.
Just out of interest, talking of that, has HMRC actually adopted the same approach with regards to the tax residency of individuals? The 90 days, 180, etc.
They have. The HMRC, for the sake of individuals, have stated that people who are stuck because of COVID, because they've been advised, which includes government advice, so simply the lockdown, there will be the leniency to ignore the days that they've been locked in the UK that they might not have been here. And indeed, this is slightly off tangent, but Guernsey is going to do something similar later this year to confirm that from a Guernsey resident's point of view for people, there will be a leniency and what they will call an exceptional set of circumstances rules.
Well, in the last minutes or so last 5 minutes or so before we go to any questions, shall we have a quick discussion around what happens when things go wrong? We're all, as I touched on earlier, we're doing the reporting now. This is the year we're making our reports for what happened last year. So,
yes,
what happens when it goes wrong?
Well, is it worth just
if
you don't comply, what the issues are?
These are rules that Guernsey, amongst the other islands, have had to introduce. Inevitably, one then has to introduce rules to show that they're operative, which means effectively there is the policing of the rules, and therefore inevitably there's a whole bunch of sanctions against anyone who should fail. Put simply, they're quite dramatic, they're quite expensive, and if one continued to repeat the failure, then in theory the last resort is our Guernsey Tax Office can actually deregister the company here. But that is such an extreme example that in practice I'm very confident to say I cannot see it actually ever happen. There will inevitably be a few cases taken because we live in an age where the regulator, in this case the Guernsey Tax Authority, will need to demonstrate that it is policing these new rules by evidencing that it has taken one or two or three cases to what will be our tax tribunal. They frankly will be the cases that they've easily found who have in fact failed. And I don't think anyone probably on the call or the business that we all involved in is actually going to be in that camp whatsoever.
And indeed, administrators wouldn't like to see the companies they're looking after falling that, would they? If I remember correctly, the scales are something like 10 grand for the first couple of years, escalated to 50 and 100.
It's 10 grand for the first year of failure, 50 grand for the second year of failure, and 100 grand for the third time. But as I say, if anyone indeed was, and this isn't in fund management, we have been advising people, and there are other areas of business which has got the potential to struggle sometimes to do this substance, nothing to do with fund management, and we have seen those companies simply move away from Guernsey in the odd case. So they will, I think, be very rare cases of failure in this regime.
So is there the possibility, I discussed earlier the idea of foreign jurisdiction companies being effectively made tax resident in Guernsey. Now, does the opposite therefore then apply if things are not happening, if SIGA's not being properly demonstrated in Guernsey? Even before the point of them being deregulated, as you say, the ultimate sanction is that they're seen to be operated elsewhere, and then not only might you get fined, you might find yourself being taxed in a different jurisdiction because it's deemed actually the property is being, the entity is being managed there. So, classic example might be managed in London, for example.
Well, it's your permanent establishment.
Well, exactly, and those rules have effectively been around again for donkeys. So I went back to the point that directed in managed is technically different to the concept of management and control, but in practice, Guernsey fund industry, Guernsey companies have been making sure companies were managed and controlled here to exactly avoid the risk of being anywhere else. And if they've done that, and they are going to continue to do that, then they are going to meet the directed managed here anyway.
I think the big takeaway from all of this, of course, is that one of the advantages of dealing with people from Guernsey, I think, for say fund managers and board looking to see what Guernsey can offer, is that actually we've got such a long history of providing substance. The substance laws effectively create a lot of people looked at it and said, yeah, we already do that. We've got to do lots more reporting. You know?
Yeah.
I agree. That's what I would hope that would be the takeaway message for people. Yes, it's not particularly onerous. It's a nuisance.
Yeah, it's just formalising under a completely different hat something that we've always done.
Yeah,
there's been no substantial shift.
Substantial.
No
shift.
substantial shift. With that point, I think I'll try and figure out how to look at, see if people have questions on this now. Bear with me. So we have some questions already. So as I mentioned earlier with pure equity, would pure equity be inside scope or not? Reference to valid intellectual property. Now this I think would be particularly within the perhaps an SPV holding company of a fund, or even let's talk about it a little bit outside of a fund, you know, outside of the investment management side. So the pure equity and the intellectual property, how is that caught up?
Well, we briefly mentioned the 9 areas, one of which is intellectual property. That would effectively trump any of the other activities in terms of the requirements. If a company is involved in intellectual property, then it will need to look at the various requirements. If one of the other 9 areas is called pure equity holding, but as I mentioned earlier, our view is that is really a pure equity holding. So it's typically a parent owning a bunch of subsidiaries, and in itself it has very little activity other than receiving dividend income from the subsidiaries, who are themselves the ones carrying out activities.
Yeah, because that's not the SEGA, is it? The receipt of income is not a SEGA for the purposes of the other rules.
Yeah, so then there are some requirements for a pure equity company, but as we mentioned, they're very much lesser.
And IP, I mean, that's a completely different kettle of fish, especially with the recent changes to look at the high risk element of the IP when an entity is holding IP. Because again, this was primarily dealt with the very large groups that place their IP within a jurisdiction, European jurisdiction, which had a preferential tax rate and you know, the Google tax that people wanting to levy and all the rest of it. Amazon tax.
Well, yeah. So let's not actually go there. This, as we mentioned at the beginning, is around the BEPS issue of trying to prevent the abusive location of profits at low tax. So yes, Amazon, etc., that use Luxembourg to do exactly the same can continue to get away with it because Luxembourg is in the EU and therefore it does not have to comply with any of these substance rules.
Heavy sigh. Forever Luxembourg gets away with it, it seems. No, actually, that brings us on to another question here, actually, about how strict our border rules are compared to Jersey. You know, we'll ignore Luxembourg then, you know, on that side. Do we see an impact on demand for Guernsey domiciled funds?
Well, I think...
This is obviously a COVID-related question.
Yes, and if the reference to border is around COVID, then in practice, I would think both islands are very similar at the moment, because I'm not sure business people are doing day trips to Jersey with all the need to go through their form of isolation stroke testing. We'll have to see where Guernsey gets to, but as I mentioned, there is the relaxation of matters, and I think that a board just needs to document in board meetings why people are unusually not attending.
But I think effectively Jersey's offshore anyway. So
yeah, but I think that question relates more to the economic impact of COVID as opposed to the economic substance. So there's no doubt we definitely have seen a drop in level of activity for the new structured launches. You know, on the listed market, you know, the capital markets, there's been, you know, less demand. There's just been one since the start of the year. So there's absolutely no doubt that COVID has led to a slowdown, but that's a reflection of the downturn of the economic activity and capital market activity.
And not Guernsey per se.
So those who are the best suited were those who obviously had their closing or final closing just before COVID, and now they have an opportunity. Obviously, I wouldn't say to pick up bargains, but there could potentially be a bit of a floodgate of businesses that would not otherwise be disposed of. And the practical impact that I've actually seen with COVID is that a lot of the those private equity funds that held their final close just before COVID, then COVID happened, they've gone back to the LPs to ask whether they could extend the investment period, because then that means that the shortfall in level of activity for 3 months can then be added on to what was normally, and that's a change to the LPA, and most of them are, because obviously they don't like people sitting on cash.
And we are seeing now activity happening, so
Yeah.
there will be new funds shortly created in Guernsey despite COVID.
And do we feel though that what COVID has done is made people more happy to do things remotely, such as this presentation here, such as having meetings, Zoom calls, team, so does that mean people are actually, I think once travel restrictions are lifted, people will happily bounce around again, but it doesn't feel quite as necessary now to travel and see the people, although of course from our marketing perspective,
that's slightly different.
We can't
the face to face
sell.
and the pressing of the flesh is different. But even our business, we've had to buy the cameras. In fact, our IT person told us that you couldn't find any other market because everyone had bought the cameras for the Zoom meetings. But you're right. I think that there's going to be a big change in practice in terms of the use of the technology a lot more than it used to be. But nothing beats going to say hello to someone.
And Steve touched on the issue of having 1 or 2 Guernsey directors, and we said it's always better to have 2 because it facilitates things. And the other answer is to possibly even have alternate directors if this situation carries on.
And I think Richard, also it all depends. If our main market is the UK anyway, it depends how quickly. I mean, there's certain organisations which I've heard, which I won't mention, large institutions that have basically said some of them are now will only do 2 days a week, and that might be a policy going forward. So it all depends. If our predominant market is the UK, how quickly the UK comes back on stream, and who's going to be at work and who's not going to be at work.
But 2 days working or 2 days working at the office?
2 days working at the office.
And that's going to be a big change. But
again,
it's a change
of a huge
attitude. But I think that's also for the economic argument, because the floor space needed is not as much as it used to be for the large financial institutions. So if they can reduce their rent by 2/5 or 3/5, which is pretty much half, then
But if those people you're seeing, if they're only in the office for 2 days, they may be swamped, and the opportunity for us to start meeting with people may be diminished. Because when they actually go into the office,
you're not going to go to their house.
No, exactly. So it's going to be interesting to see how that plays out over the next 6 months.
Right, so let's move on to this last question we'll take, which hopefully is a quite like this question. Are you finding UBO and or clients that understand the concept of substance in your experience? I think that actually is a very good question. Not that the other questions were good, because of course we're again, from my fund administration sort of background experience, we're having to do more work, and we're having to explain to people why there's more work around evidencing things such as sort of Seagull side of things, why it's important that we need to have 2 directors in the office here. I think people generally get it from a tax perspective. What's the feeling around it?
I think it's a bit like today. It's going through it, explaining why it's there, what one needs to do, and then, as I mentioned earlier, it just becomes a little bit of an administrative hassle to comply, or rather to evidence that you complied.
Yeah, it's not a change to the substance of the services, because the UBO should never have directed pre-COVID, let alone during or post-COVID. But it's true. I mean, everyone is sensitive to costs.
Yes.
I think one of the drawbacks is the evidencing is, as you rightly say, people are probably going to end up charging more for it because of the obligations imposed on the service providers.
I have to readily admit that we will have to charge clients a little bit more to fill in tax returns, because there are now 5 pages of silly boxes to fill in.
We need to keep time records. I mean, generally most companies do anyway. But I think for me, it's pushing the NEDs to give a decent breakdown or analysis of the time they spend on the entity, and of course for when the non-Guernsey based directors come into the island and the time they spend on island as well. Keeping an account of that, which might of course include time there in the hotel at night going through the board packs.
Well, I think we have to, because now there's register of the FTEs, or the full-time employees, which includes the directors and the time spent, which we have to justify as part of the reporting.
I would expect the fund manager service provider here in Guernsey would have a good handle on that, dealing with it now all the time, and frankly be able to help directors, etc., get to those records.
So when it comes out, I think one of the points of the question is understanding the concept of substance. And I think people generally, when we've spoken with anyone about it, understand. We need to prove the entity is tax resident in Guernsey. This is because of the whole EU thing. I think generally they're accepting that it has to be done.
Well, it's not a matter of choice.
Well, no, I know. So when it's not terribly hard to explain. I think it often depends on who the UPO is, and the client is as to quite what they're after. I mean, of course, the benefit for them is that as long as the job is being properly done in Guernsey, we actually now have I guess an EU supported definition of why this company is tax resident.
Indeed, particularly in the fund industry, we've never really seen challenges from HMRC about whether a company was managed and controlled in the UK. As you say, this effectively will give it a total stamp of authority that they wouldn't even, I suspect, ever consider raising such a query, because we've proved actually we've got substance here.
Well, great. I think I'd like to thank the panel here. Thank you, Gavin. Thank you, Mark. Thank you, Steve. It's been really an interesting discussion around about substance, and thank you all for attending, and thank you for those questions as well. So it just leaves me to really say goodbye, and hopefully you'll come to one of our next seminars.
Thank you.
So thank you very much.
Thank you, Richard. Bye.
Thank you.